What's up guys, it's Nick True, and today I'm going to talk to you about what your credit score is and exactly how it's calculated. Now I have a score of about 760 and my wife has one just over 800. Getting a really good credit score starts with understanding how that number is calculated, and that's why I'm going to show you the 5 factors that impact your score. Alright, so first things first, you need to understand that there's actually more than just one credit score. There's hundreds of credit scores out there. Different lending agencies like car dealerships, credit cards, and banks all use different ways to calculate your credit score or your credit history. And it can be super confusing because not only are these scores calculated differently, they also use completely different scales. The most common score, and the one you're probably familiar with, is called a Fico score, which used to stand for the Fair Isaac Company, and I think now they recently changed it to Fair Isaac Corporation. It doesn't really matter. All you need to know is that that's the score that most people use and most people compare to. If you have a good FICO score, you can pretty well guess that all the other scores are going to be pretty similar and you're going to be okay. Now the FICO score is on a scale of 300 to 850. Now technically you can have a FICO score of 0, which basically means you just have no credit history at all. That's probably what you have when you're 18 and you just don't have anything. A good score is going to be anything above 760, 780-ish. If you're above that, you're going to be getting the best rates on your mortgages and you're pretty much going to be approved for whatever credit cards you want. As long as you have above that number, there's really no big point to trying getting 850. It's not worth it. So how's this thing calculated? Like I said earlier, there are 5 different factors that impact your credit score. Number 1 is your payment history, which amounts to 35% of your overall score. Now this is the most important factor of your score and makes up the biggest portion. It simply looks at, are you paying all of your bills to your lenders and creditors on time, or are you late? Now like I said in the video on credit cards, if you're already not paying on time, you've got bigger issues going on than just having a bad credit score. By missing payments, you're going to completely kill that credit score, which is going to cost you thousands of dollars in interest down the road if you ever apply for a mortgage. It's also going to cost you hundreds of dollars every year in late fees now. You have to strive to be paying all of your bills on time and in full every single month. Now I know that sometimes this just isn't possible. There's stuff that comes up, life happens, I get that, but that's the goal that you have to be striving for. Alright, so the second category is amounts owed. Now this makes up 30% of your overall score. Now this category can be pretty confusing, but it makes up a huge portion of your score, so it's important that we understand it. Let me break it down into revolving credit, like credit cards, and installment loans, like a student loan. So for revolving credit, the amount owed looks at what's called your credit utilization ratio. This is a factor that looks at how much money you owe on the card versus how much you have available to you. So let's say you have a credit card that has a credit limit of $1,000 and you've charged $500 to that card. What this means is that your credit utilization is 500 over 1,000 or 50%. If you have a $10,000 credit limit and you've charged $1,000, then your credit utilization ratio is 10%. Not only does your FICO score look at the individual utilization on each account, it also looks at your overall utilization to make sure that you're not overusing your credit as a whole. Let's look at an example. Let's say you have a Discover It card, a Sam's Club card, and a TJ Maxx card. On the Discover, you have a credit limit of $3,000 and you have a balance of $450. Now on the Sam's Club card, you have a credit limit of $4,500 and your current balance is $1,100. And for the TJ Maxx card, you have a credit limit of $1,500, but your balance is $700. Now this means your total available credit is $3,000 plus $4,500 plus $1,500 equals $9,000. That's all 3 of your cards added together. And you currently owe $450 plus $1,100 plus $700, which equals $2,250. So this means your credit utilization ratio is $2,250 over $9,000, or 25%. Now in order to maintain a high credit score, you want to keep this overall utilization under 10%. As a good rule of thumb, that just means to keep the balance of each card under 10% of whatever the limit is on that card. If you're consistently using up almost all of your credit, even if you're paying your bill in full every month, you look risky to lenders because they don't want to let people borrow money who are constantly taking advantage of everything they have available to them. Now if you're thinking there's no way you can stay below 10% because your expenses every month are just way too high, that's okay. You just need to be doing one of 2 things. Either log into your account every single week and pay it off early to keep that balance down, or just use up to 10% of whatever card and then start using debit for the rest of the month. Now remember, since you're paying in full every single month, then using debit shouldn't be a problem because you're not buying more than you can already afford anyways. Now if you're not doing that already, then again, we need to focus on getting you to that point before you start worrying about your credit score. Now earlier I said amounts owed doesn't just look at revolving credit like a credit card, it also looks at installment loans. This means if you take out a $10,000 loan to buy a car and you've only paid $2,000 on it, you still owe 80% of the loan plus interest. In this case, FICO cares about how much much you still owe on the car. Now, unfortunately, there's not a good rule of thumb with installment loans like there is with credit cards that says if you've paid down 10%, then you get a really good score. In general, though, FICO is going to look at how much do you still owe on the car, because if you still owe a whole lot, then lenders are going to be less likely to want to give you money. If you've paid down a lot, then they see, okay, you're good with credit, you're good with what you're doing, we'll give you a better score because you're responsible. So in general, if you have an installment loan, whether it's a student loan or a car loan or a mortgage or whatever, you want to try and pay that down. Not only is that good for your finances in general because it just helps you get rid of interest and saves you money, it also helps your credit score as well. All right, so those two things alone, the amounts owed and your payment history, make up 65% of your score, which basically means if you can never miss a payment, keep your utilization low, and always pay in full, you're gonna have a really good credit score. But let's go ahead and look at those last three factors that affect your score to really push you over the top. The third factor is your length of credit history, which makes up 15% of your overall score. Basically, this just looks at how long have you had a credit history and how old are the accounts that are established. FICO is going to look at your oldest account, your newest account, and all the accounts in between and give you an overall length of credit history score. This is why if you still have your first credit card, you should never cancel it as long as it doesn't have an annual fee. Keep in mind, this 15% doesn't look at anything else other than the average age of your account. So if you're really trying to apply for a mortgage or something like that next month and you really want to get a good score, the last thing you need to be doing is opening up a new credit card or something else that's going to bring that average down. Now, many people think that applying for new credit is going to hurt their overall credit score because it counts as a hard pull or a soft pull or it checks their credit. And yes, that does happen, but as long as you're not getting hard pulls regularly, most of the time your score will come back pretty darn quick. But sometimes if you have like only one credit card account or you just don't have that much loan history and then all of a sudden you open up a brand new account, it's going to bring that average age way down. And so sometimes your credit score can take a dive for much longer than you initially thought, and it has to do with the average age of accounts and not because of the hard pull. The bottom line here is if you really want that length of credit history to be good, don't cancel your old accounts and just keep on keeping on. All right, so the fourth factor is credit mix, and this only makes up 10% of your score. Basically, this looks at, are you responsible handling a variety of different types of credit and loan, or have you only had experience with like one thing? For instance, do you have a car loan, credit card, student loans, mortgage, etc.? Even if you've been really responsible with your credit cards and you've built up a good score based on credit card use, getting a car loan could be different if you've never had one because lenders in the car industry want to specifically see loans for that thing. It's pretty stupid, I know, but it's just the way it works. Now, this is where credit scores get dangerous, and this is why sometimes I hesitate to even talk about credit scores, because sometimes people can start chasing that credit score and it becomes a detriment to their financial health overall. For instance, I hate car loans. I hate them. I'm so passionate about that. I hate debt in that way. The last thing you need to be doing is trying to build your credit score by getting a car loan in a scenario where you could get a used car that you could pay cash for or something like that, but you justify it because you want to build your credit, and so you go and get a car loan anyways. That's insane. Never do that. You can have an extremely high credit score without ever getting an installment loan. Yes, some lenders may still have a weird time when you do want to get a mortgage or something like that one day, but that's okay. You'd rather save the money on the interest and not paying all those loans over the years just to get, another 10, 15, or 20 points on your credit score. That doesn't make sense. All right, so the fifth and final factor that affects your FICO score, man, say that 5 times fast, is new credit, which makes up only 10% of your score. This is another small portion that basically just looks at how often are you opening up new accounts? Are you getting a new credit card every couple months? Are you applying for a new loan every few months? How often are you applying for new stuff? Essentially, the more often you open new accounts, the more risky you are to lenders. Simple as that. Now, I want to reiterate, having a high credit score is not the goal here. It should never be something you're highly focused on. The credit score has unfortunately been marketed to be more important than it really is. Yes, it's semi-important and you should pay attention to it, but you should never go chasing after it. Having a good credit score can help you in the long run, but if you're overly focused on it, you're going to end up making stupid financial decisions. So understand them, follow the best practices, and then forget about them and go on living your life. So that's it, guys. Now, I know credit scores can be super confusing, so hopefully you learned something here today. Don't forget to subscribe to this channel for more videos like it, and remember, I can teach you how to use credit wisely, but I can't make you do it. The choice is yours. I'll see y'all next time.